Hi guys, G-Economics here. Today I'm going to run through the process of quantitative easing. So quantitative easing has been used by the European Central Bank, the Federal Reserve Bank, and of course our own central bank, the Bank of England. I want today to explain simply the mechanism and the mechanics behind quantitative easing, and then in future videos I shall look at the problems associated with quantitative easing. So, first of all, in the UK economy we have had 4 rounds of quantitative easing since 2009. You'll know that a recession kicked in 2007. Immediate response of the Bank of England was to pull on the lever of the base rate of interest. Base rate of interest fell dramatically over about 6 to 7 months from 5% down to 0.5%, where it has remained for the last number of years, indeed the longest period of 0.5%, the lowest rate of base rate in history actually. So we've had this 0.5% rate, but that didn't really stimulate any economic growth, and so the government and the Bank of England put their heads together to try and come up with some other type of lever, because they'd already pulled on the base rate lever, they'd pulled on the fiscal policy lever of government spending and taxation, with which of course there was little room to manoeuvre because our national debt budget deficits were so enormous anyway. And so quantitative easing was another lever which could be used to try and increase GDP growth in the UK. So we've had 4 rounds, and currently in the UK economy we are sitting on £375 billion worth of additional funding into the UK economy in the form of quantitative easing. So how does this quantitative easing work? First of all, the Bank of England electronically creates additional funds, and in this case it's been to the tune of 375 billion. With that money, the Bank of England then buys bills, such as treasury bills, short-term loans, and bonds, government bonds, otherwise known as gilts, and the Bank of England purchases these from financial institutions and retail banks. If you look at my video on the transmission mechanism, which I did not so long ago, you will know there is a relationship between the demand for bonds, the price of bonds, and interest rates, lending rates. And the basic premise is, there's more detail on this in my previous video, but as the demand for bonds goes up, which it will do in this case because the Bank of England is buying them, so the demand for bonds goes up like so, D1 to D2, very straightforward microanalysis, demand and supply. That then pushes up the price of the bond. Now you'll know from my previous video, when the price of the bond rises, the interest rate falls. And so when the Bank of England starts along this road of quantitative easing, whereby it's purchasing all of these bonds, the bond prices rise, but as the interest rates fall, long-term lending rates also fall in the economy. Which of course, if you are wanting to borrow money for a new car, or if you're a firm and you want to borrow for a new multi-million-pound machine, cheap lending rates are very important to you. So the RBs, the retail banks, and the FIs, the financial institutions, now have all this additional cash sloshing around, 375 billion, with which they could do a few things. Number one, they could increase their lending to consumers such as you and I, or to firms wishing to expand, invest, bring in more labour, etc., etc. If they were to do that, that would of course increase GDP in the economy. The other thing that might happen, probably would happen, and probably would be an indicator of a successful quantitative easing is this. Financial institutions would be holding bonds in the first instance as an investment. Could be pension funds or anything going into those bonds to make a return. Well, when the Bank of England buys the bonds and the price of them goes up and the interest rate falls, these financial houses will say to themselves, well, there is no point in us buying bonds because the return in terms of the interest rate is falling. We need to look elsewhere. Where else might they look? They might look to the stock market. And so another thing which may happen as a consequence of quantitative easing is that there will be more investment in stocks and shares on the FTSE, and as a consequence of that, share prices will go up. But of course, as you know, when you buy a share from a company, you are in effect lending them some money. And so the companies indirectly would again have more loanable funds accessible to them because of this increased investment in the stock market. So you get increased lending purely from banks in the normal way, but also you get an increase in the amount of loanable funds available via the increased investment in the stock market. Now, as a consequence of all of that, that should then lead to economic growth in the economy. So we in the UK, we've had 4 rounds of quantitative easing, and we're sitting on this £375 billion worth of QE into the economy. The question as to whether or not that has actually led to economic growth, well, that is something which is very much up for discussion, and I will then consider that in videos to come in the coming weeks. So any questions on that, do drop me a line and I'll try to get back to you. Bye for now.